One of the core holdings of a mutual fund portfolio are the large cap funds. Now, the word cap over here refers to the market capitalization or the size of the company. And the top 100 companies by market capitalization are called large cap stocks. And the funds that invest in these large cap stocks are called large cap funds.
Yes, Sumera. Actually, large cap funds are the simplest portion of equity mutual funds. As per the SEBI regulation, 80% of the large cap fund's total amount needs to be invested in the top 100 companies. The size of the 100th company is close to 29,000-30,000 crores. So the kind of stocks you get in your portfolio, in effect, by buying a large cap funds, are these big, massive companies which have been into existence for long periods of time, have a good corporate governance, have a low volatility in their price movement, and several other things, which is good management, is what you get along buying a large cap fund.
That's right, Feroz, because they do tend to add stability to an investor's portfolio, right? But for this stability, is the investor actually going to be missing out on returns?
It's a very valid question, Sumera, because every time you reduce the risk, there is some degree of dampening on the return side, which is not apparently visible to you. In case of a large cap fund, relative comparison with a small cap fund tells you that your risk is 50% lower in a large cap fund. The return per annum is lesser by 2.5% year on year if you compare both the categories and the entire universe.
But you know, Feroz, within, say, the universe of mutual funds, large caps may have a slightly lower return. But within the large cap universe as well, there's a big difference, right, between the best performing fund and the worst.
That's an amazing question, Sumera. In fact, the dispersion in the performance of all the large cap funds is large enough for you to notice. The 1 year performance of the best large cap fund is 7.25, whereas the worst large cap fund performance for 1 year is minus 14.66. That's close to a 22% dispersion between the best and the worst on a 1 year performance. And on a 2 year performance, you still see almost a 12% difference, and a 3 year performance between the highest or the best performing large cap scheme to the worst is close to 9%. This dispersion is actually the reason why selecting the right large cap fund is very critical. Currently, there are about 30 to 32 large cap funds, and if you are a retail investor and have one fund in your portfolio, that better be the large cap fund.
Mid-cap funds are funds which invest in mid-cap companies. What are mid-cap companies? Well, they're the ones which are tightly packed in between the large and the small cap ones. As the name denotes, these are the mid-caps, which mean anywhere from 101 to 250 according to market cap would make up this set.